Hello and welcome to Money Markets and More, coming to you today from Croatia, from a campsite in Croatia where I've been doing some weird canoeing challenge thing. And today we are talking about the art of timing, famous market cycles and their implications. Before we begin, here's a quick look at the river. You can probably hear it in the background, very beautiful this time of day. If you should happen to be in the Scottish neck of the woods this August, I'm doing one of my lectures with funny bits at the Edinburgh Fringe this year. It's a lecture about gold. It's got Greek gods, it's got interstellar collisions, heists, Nazis. What more could you want in a show? And that's from August the 4th to the 20th. At 2 p.m. Please come if you're in town, and I'll put a link in the description where you can get tickets, and plus an added bit of history. It takes place in the room in which Adam Smith wrote Wealth of Nations. Anyway, here's the river, looking absolutely splendid. I should just really stand here and talk for a bit. We canoed through those rapids yesterday. Anyway, cycles. So the wheel is come full circle, commented Shakespeare's Edgar on the carnage that surrounded him at the end of King Lear. And the notion of a wheel of fortune is one that has pervaded since antiquity. There are good times and bad times, there are bull markets and bear markets. There is boom and bust, something which Gordon Brown, when Chancellor, so hubristically promised he was going to eliminate. But whether it's the seasons of the year, the moons, the inevitable aging process, the cycle of life, what Shakespeare's called the 7 ages of man, it's clear that there are recurring patterns to the world around us. There are even recurring patterns in the length of women's hemlines. And anyone who's been involved in business for any significant amount of time will know that markets never go up forever, even with money printing, but they're subject to the same cyclical movements. Commodities are very prone to cycles, so-called secular bull markets or super cycles. In 1947, Edward R. Dewey and Edwin F. Dakin, they published a book called Cycles, The Science of Predictions. It's now out of print. But they noticed a 54-year cycle in wholesale prices, in other words in commodity prices, going back to 1790. And based on this they made projections for the future. They called it the 54-year rhythm. And if you look at their long-term chart of forecasts, their forecasts were pretty accurate. The 1980s and 90s were a clear secular commodities bear market, the noughties a clear secular bull market. The 2010s were another secular bear, the 2020s a bit of everything. And thinking in basic terms can be an effective way of investing. Are we in a bull market or a bear market? How long does this bull or bear market have to run? Find a bull market and go long. That's all you need to do really as an investor. There's no point picking brilliant stocks if the sector they're in is in a bear market. It doesn't matter how good a stock picker you are. Mining companies themselves go through clear cycles. Perhaps phases is a better word, from exploration and discovery through development and mine building to actual production. New technology goes through a clear cycle as it evolves. Let's look at that lovely river again, which research firm Gartner described as the hype cycle. You look at what happened with .com and the internet, from invention, excitement, bubble, to collapse, to mainstream adoption. Felix Dennis, in his book How to Be Rich, talked about riding the wave. You get into a new growth area early and then surf to riches. And so thinking in terms of cycles can help you to frame the bigger picture. It can give you an idea of where you are in the grand scheme of things. Where am I in the cycle of my life? And we like reading about cycles because they bring a veneer of certainty, of clarity, security, comfort, where there is in fact often none. But most of us have a slightly superstitious streak, which means we can be vulnerable to cycles' narratives, too easily persuaded by them, too easily wedded to them. I remember Around the time of the global financial crisis in 2008, many became obsessed with the idea of Kondratiev winter. And in his 1925 book, The Major Economic Cycles, Russian economist Nikolai Kondratiev had identified a long-term cycle lasting approximately 50 years, like the Dewey and Dakin cycle. But as I say, cycles make good copy. And Kondratiev made his name peddling them. He had spring, summer and autumn. And now, 2008, we were headed into winter. And that notion was confirmed by the collapse in financial markets happening in real time around us. The narrative took hold. Many buckled down, gold, tins, guns, ready for a Great Depression, only to miss out on one of the most epic bull markets in history. Back in 2005, economist Fred Harrison wrote about an 18-year cycle in UK property in his cult classic Boom Bust House Prices, Banking and the Depression of 2010. And in 2005, many had already turned bearish on UK property with good fundamental reasoning. Harrison wrote a famous article in Money Week. He said the bull market had further to run and the top was actually going to come in 2008, and he was right. There were still 2 more years of bull market. The peak actually came, I think, in the third quarter of 2007. The problem is, the trough was so short-lived, a couple of years maybe, got the global financial crisis, but I don't remember the depression of 2010. Looking back, there was a buying window in UK property during that 2009 to 2011 period, but prices, especially in London, didn't fall by anything as much as many were hoping. Interest rates were slashed and there were few forced sellers. Without the rate cuts, house prices would have come down by a lot more. By the turn of the last decade, it was off to the races again. If you sold in 2007 but were too wedded to the cycle theory, then you would have been waiting for lower prices and never got back in again. Harrison, by the way, is forecasting the next peak in UK real estate in 2025, and he may prove right. Recent data suggests the market's already picked and that but it's in another false top, such as we saw in 2005. We'll see. Another popular cycle is the 4-year presidential cycle in US stocks. A few years ago, GMO's Jeremy Grantham, one of its main proponents, declared that it doesn't work anymore because the US Federal Reserve has broken it. It was money printing. But here we are in 2023, in the 3rd year of the presidential cycle, and the S&P 500 is acting it out to the letter, rising to new highs when few expected it. The idea of the 4-year cycle, by the way, is that economic sacrifices are made during the first 2 years of the president's term while it's still okay to be unpopular. This results in the 4-year cycle low in the stock market, and then in the final 2 years of the term, the focus shifts towards stimulus to boost the economy ahead of the next election. And that 3rd-year boom is just what we are seeing now. So cycles are all very well in theory. They make a great topic for discussion, but trading them in real time is a different prospect altogether. It's too easy for an academic or similar to look back at history, find a pattern and declare it a cycle. When real life doesn't fit the model, you'll hear something like, oh, well, the war upset the cycle, or they printed loads of money so the cycle didn't work. Markets aren't fixed, and they're not predictable in the same way as the days and weeks of the year. I like writing about cycles. I like reading about them. I think they help guide you through life. But at the same time, when the word cycles comes up in investing, I breathe out and try and erect a defensive mental wall. Heaven forbid I should get too wedded to them. Real life and academia are not the same. Thank you very much for watching this. Please subscribe to the channel if you haven't already. Check out my Substack, my paid letter, loads more great content on the way. And yeah, if you're in Edinburgh, as I say, please come to that show at the Edinburgh Fringe. And if you're interested in buying gold, I'll put a link to my favourite gold dealer in protecting your wealth and all the rest of it. Thanks very much for watching. Subscribe to the channel. I'll be back very soon. Goodbye.